So welcome to Cunningham Legal's presentation on how to sell property and not pay taxes. 1031 exchanges, that's what we're going to be talking about today. And we've talked about this topic in the past, but today we are going to be talking about how Proposition 19 affects 1031s, how somebody can potentially pass their low property tax to their kids, and their kids can not only keep the low property tax, but they can potentially avoid the capital gains in the future. So before I start going through the presentation today, I have to give you our disclaimer. Everything we talk about today is purely for educational purposes only. It is not legal advice. And why is that the case? Well, today's presentation, it is not legal advice because I haven't seen your particular situation. I have not seen what makes this situation unique to you. And because of that, I can't apply the law to your unique set of circumstances. So today's presentation, totally for educational purposes only. You know, we offer our clients, we offer potential clients the ability to make an appointment with us. And at those meetings, we're able to go over your situation. At those meetings, you know, if you've had a meeting before, you know that we make you fill out a form that talks about your family, that talks about your assets, when you purchased your assets and for how much, so that we're able to apply the law to the facts. And we're able to actually give you advice, because that's what you're paying for when you meet with us, is the legal advice. So today's presentation is just a bunch of information. You can try to apply the information to your own set of facts, but really, to make sure you do it correctly, you should consult with an attorney for proper legal advice. Okay, so let's go through Cunningham Legal. Cunningham Legal, we are a 7-person team. Our firm was founded by Jim Cunningham. He's up in our picture to the right. Jim, you know, he started practicing, I believe, in 1994. He wrote a best-selling book on estate planning, Savvy Estate Planning. It's on Amazon.com. It's a really easy read. A lot of our clients, they came to us because they discovered our firm through Jim's book. We have 6 other attorneys. We have offices in the Sacramento area, Roseville, Folsom, Auburn's our headquarters. And then down here in Southern California, we have Pasadena, Huntington Beach, and Westlake Village. So you can see our different attorneys. We're broken up really into 2 different sectors, we'll call it, planning and administration. So planning is going to be planning for what happens when you die, planning for what happens if you become incapacitated, and planning for tax purposes as well. And that's what we're talking about today, is planning, okay? The other half is going to be administration. So administration, that's going to be unwinding a trust. It's going to be assisting a loved one if they're incapacitated or if they've passed away. And like I said, the planning portion of it, that's what we're talking about today, particularly tax planning. Within our firm, you can see me at the bottom, Connor Clemens, I do planning. On the left, Jeff Rosen, he does planning. And then you have Tasha, she's our Northern California planner. And then you have Jim. Jim will do some planning, but you know, he runs the business and he does administration as well. But all 4 of us, we really meet with clients and we talk about these Proposition 19 and 1031 issues. Our trust administration attorneys are Rochelle, Liz, and Janice, all great attorneys. You know, they really get to be involved with people's families because they're going through those difficult situations, but we all have our role to play. So me, Connor Clemens, I have been with this firm for a few years. Like I said, I do the planning myself. My background is totally taxation. So after law school, I did my master's in tax law at Loyola Law School. And since then, it's been totally about taxation. And that's what we're going to talk about today, is tax. And my goal for this presentation today is to be a little bit more relaxed. We are close to, you know, holiday break for most of us between Christmas and New Year's and all that good stuff. So I'm going to try to go a little bit slower. I'm going to really try to hone in on these issues. A lot of our webinars, we talk about a billion different things. And today, I'm still going to talk about a lot, don't get me wrong, but I'm going to try to go slow. And if you look at your box, I'll call it, your bar, it gives you a box for Q&A and it gives you a box for chat. If you do have questions throughout today's presentation, you can click on the Q&A and submit them, and I'll typically go through them as we go through the presentation. And of course, I'll allow for Q&As at the end of this presentation. And I think it's about what, 10:05 right now? This presentation will probably go till 10:45 or to 10:45. If I'm really stuck on the questions, it might go a little bit longer, but I know that we're all busy. So let's try to get through this. So why are you here? Well, you're probably here because you own real estate, or maybe you're going to inherit real estate soon. I don't know. But real estate, that's the driver of this conversation today. And you might want to sell your real estate. You might want to pass your real estate to your kids. You might be here because you've heard about Proposition 19. That's really been a big driver in California since it passed in November. A proposition that really took the world by storm because it wasn't on our radar as much as something that was as likely to pass. You might be thinking about leaving California. I can't tell you how many people I've met with in the past month who have pointed out to me that they're open at least to leaving California, if not just frankly planning on leaving California. And we're going to talk about some strategies to hopefully just avoid paying capital gains, to avoid paying taxes, but maybe delaying paying taxes. We're going to talk about trying to avoid reassessment. We're going to help you stay one step ahead, because it's a lot easier to plan than it is to clean up a mess. And if you've done any planning before, if you've done work with trusts and estates, you'll know that it really is a lot easier to plan than it is to clean up a mess. And that's why you're here today. So let's kind of talk about taxes to start. So there are all different types of taxes in life, right? We have income tax, capital gains tax, estate tax. That's going to be like the death tax, estate tax. You have property tax we're going to talk about. And then, of course, you have your sales tax, excise tax. Well, today we're talking mostly about two taxes. And that's going to be capital gains tax. And that's going to be property tax. And we're going to start with capital gains. So what the heck is capital gains? Some of you, this is going to be review. We'll start digging a little bit deeper, but we could all use a little bit of review. So let's say you bought a token for $1. Okay, you just bought a token, or I'll call it a coin. You bought a coin for $1, and today it's worth $3, and you sell that coin. Well, you had $2 in gain, right? Your $3 you sold it for minus the $1 you bought it for, $2 in gain. So that's going to be capital gains, and you're going to pay tax on that gain depending on how much money you make. Typically, you're going to pay tax. So we have our example. A lot of people I know are really visual learners. I can be a visual learner too, so I'm trying to cater to everyone. I'm going to go through an example today where we have a guy named Doug. And in this example first, Doug, he bought a property for $200,000, and that's what this is trying to illustrate here. He bought the property for $200,000, and he's selling it now for $400,000. And that means easy, right? He has $200,000 of gain. Well, it's not that quite that easy. We're going to have to talk about depreciation too. But just for the purposes of trying to explain what we're talking about, is he bought the condo or the property for $200,000. He sold it for $400,000, the duplex. So $200,000 in gain. So he's going to pay tax on that gain. Now, capital gains, federally, you're going to pay 15%. Typically, you pay 15% unless you're in the highest tax bracket. Then you pay 20%. Okay. And if you're selling this property in this year, there's a good chance you're going to get bumped up to that higher tax bracket because you have all that gain from the 1 year. Now, depreciation, I'll come back to in a little bit. We don't just have to worry about federal, though. We're in California. This whole webinar today is really based on California, obviously with Proposition 19. But in California wants to tax you as well for capital gains. And they're going to hit you with, at least 9.3%. So we'll talk all about that. The numbers I'm really going to try to stay away from. We'll just call it a tax. But let's go through an example. So Doug, he buys his duplex for $200,000 in 2010. Today, it's worth $400,000. Now, when you buy a property, a residential property like a duplex, the value of the building gets depreciated every single year. So how do you figure that out? So let's say the building that he purchased, the whole thing was worth $200,000, but let's say the building was worth $150,000. Okay. You take that $150,000 and you divide it by 27 and a half, because a building, a residential building, typically is depreciated over 27 and a half years. And so that leaves you with about $5,454. That's what happens if you divide 150,000 divided by 27 and a half. So every year, Doug, when he owned the property since 2010, he deducted about $5,454 as a loss on his income from the property. But every year he does that, he depreciates against his basis. So his basis, even though he bought it for 200,000, the amount he bought it for, it goes down every single year, okay, by about 5,400. So over the 10 years, he's taken about $65,000 in depreciation, which means his basis has gone down. So I go back to this image here, and you can see how he has depreciated. His basis, even though it started at 200,000, it's now below 150,000. So if Doug sells, he gets that offer for $400,000, what happens? So he's going to have to pay gain on his $200,000, and then he's going to have to recapture, it's called, all his depreciation. He's been taking those losses on the building for the past 10 years. And those losses, he obviously didn't take that much of a loss because he sold the house and he made $200,000 in gains. So now the IRS wants him to repay back all that depreciation. It's called recapturing the depreciation. So not only is Doug paying on the $200,000 in gain, he's also paying on that depreciation as well. And I'm not going to stick on depreciation too much because I know it gets confusing, but I have to let people know it exists. So if Doug sells the property for 400 grand, okay, his gain is 200,000, and that's going to be taxed probably at 20%. If he's in that highest tax bracket, 20%, and even if he's not, it's going to be 15% for everybody else. And then he's going to have to recapture the depreciation. That 65,000 that he deducted over the years, the depreciation tax rate is going to be 25%. So he's going to pay 25% tax on that 65,000 he's depreciated. Now in California, like we know, there really are no capital gains tax. It's just income. And in California, they're going to tax you up to 13.3%, which is really high. I think that's higher than any other state. And, you know, it's California, so they're even talking about raising it now. So 20% is going to go to capital gains federally. You see it down here, so 40,000. 25% of 265,000, the depreciation, that number is off, but okay. 13.3% California income tax comes out to the 35,000. And then the 3.8% net investment tax, this is the Obamacare tax, $10,000. This is assuming that he made over $200,000 in the year. So this number is correct down here. If he's in that highest tax bracket and he sells that property for 400,000, the one he bought for 200,000, he'll owe 101,000. So naturally in California, people are trying to mitigate. They're trying to lessen their capital gains tax. So let's go through that. I do want to point out that this number right here is incorrect, the 116. We get a lot of YouTube commenters these days pointing out what's incorrect. This is an error. I don't know the actual top number off the top of my head, but it should be 25% of the 65,400. So maybe it is 16,000. It should not be 265. All right. So naturally, Doug, he wants to avoid the capital gains. And so what does he do to do that? Well, he does what is called a 1031 exchange or a like-kind exchange, whatever you want to call it. But what that is exchanging a property. And when I say exchanging a property, like a lot of people, when they think of a 1031, they imagine somebody trading properties. They think that they take their investment property and they just straight up trade it for like another person's property. Well, that's not what it is. So just me explaining it in a sentence, it would be you potentially selling your investment property and then immediately buying a new property. And as long as that new property is worth more or the same as the old property, you can defer your taxes. And a lot of the times you can eliminate your taxes altogether. So it has to be a business property. That's going to be your first element here. So you can't do it on the house you live in or a vacation home unless it's a business property first. So why is it called a 1031? Because the code section that all the rules are under is Internal Revenue Code 1031. So if you're trying to do your own research, that's exactly where you look. And a lot of people, they do 1031s their entire life. And it's a very attractive thing, you know. I mean, that's something I'm looking at doing my entire life is buying a property, growing equity in it, and then selling it and buying a nicer property and just deferring the gain. Because what happens is, and we're going to talk about this, when eventually when you die, and you pass it to your heirs will get what's called a step up in basis. And that number that you bought it for just restarts. And so if you do it that way, you are going to effectively eliminate all of your capital gains that you'd ever have to pay. So it's an excellent tool for planning. So I'm not going to spend as much time on the 1031s as we have in previous webinars, but I'm still going to use all these terms. So we have the exchanger. That's going to be the person who's doing the 1031. So in our little hypotheticals here, that's going to be Doug. And then the relinquished property, that's going to be the property that Doug is giving up. So if you are going to do a 1031, you sell your property, that's the relinquished property. And the replacement property is the property that you end up with. The buyer, that is not Doug. That is going to be the person who ends up buying the relinquished property. And the seller is the person who's going to be the person who ends up selling the replacement property. And then you have a qualified intermediary. So there are some really strict rules, and that's what that past slide was saying. It's not like you do a 1031 by, you know, selling a property, buying a property, and crossing your fingers. You got everything right. You have to use someone called a QI, or a qualified intermediary, to hold the funds, to make sure that everything is done under the Internal Revenue Code rules. So let's go through an actual example. But first, I guess I have to say, everything here has to be very timely. So before you do anything at all, this is how coordinated, how much of a planning you have to be. Doug, in our example, he has 45 days to identify a replacement property. And that 45 period can be started and stopped, but he has no more than 180 days to finish the transaction. And the 180-day requirement is not stopped and started, it just runs. So really, you have to be squared away. You can't go into a 1031 without really planning or at least having guidance. So now let's talk about a 1031. This is your traditional 1031. So Doug, he wants to exchange up from his $400,000 property. He has this duplex right now. He wants to have a fourplex. So Doug sells his duplex, and he has to find a replacement property that is worth equal to, or greater than his property, his duplex that he gave up, the relinquished property. All net proceeds that he's received during the sale, they have to go towards the replacement property. So what that means is if he has any cash, if he has any equity from the sale, not counting the loan, he has to put it towards the replacement property. He can't like take it as income. He can't take it and go buy a car or go put it in the bank or go buy stock. He has to put it towards the replacement property. So what happens is he has that $400,000 from the sale of the first property. Okay, let's say he bought that property for $200,000. Okay, we're going to go off the exact same scenario. So he bought the property for $200,000. Now it's worth $400,000, but he doesn't want to sell it and pay $200,000 in gain. So what he does is he sells it, and then he buys this fourplex worth $700,000. Now he uses a QI to wire the sale of the $400,000 property, of the relinquished property, to the escrow company for the new property, the $700,000 property. And that's what the QI is. Doug can never hold the funds from the sale of the original property. He just can't touch them. They have to go directly to the new replacement property, this fourplex. Now, he can take out the $300,000 loan to purchase this property, and he gets to depreciate against this $300,000 loan. So he keeps his original depreciation of 161,000, and he adds on the 300,000 from the loan. So I mean, really, it makes it a really attractive purchase because not only is Doug deferring any of his capital gains since he's reinvesting, he's acquiring new depreciation that will help his taxes or his income on the residence for the future. So if you want me to just sum up what just happened, I guess I'll do it. Doug bought the property for 200,000. Okay. He sold it for 400,000, but instead of taking it out as cash, he immediately reinvested in a $700,000 property. He didn't have to pay any capital gains. If he would have cashed out, he would have owed $200,000 in gain, but he reinvested. So there's no gains. But what's the catch? It's not much of a catch, but there is a catch. This new property, this new $700,000 property, the basis is still $200,000. Okay. It's the basis from his old duplex or his duplex. So if Doug sells, if he liquidates this $700,000 fourplex, he's going to pay $500,000 in gain. So that's why it's a deferral strategy, because if he ever liquidates, he's going to owe a ton of tax. So just keep that in mind. It is really it's a deferral tactic more than a tax elimination tactic. But if everything's done properly, it can be a tax elimination deal. Okay, so what is boot? So let's go back and change the facts here. So I guess this story came from Jim. So I'm going to pass it on and tell it like it's my own. If two parties determined that one horse was worth more than the other, the person that received the more valuable horse had to pay something to the other. So like, a boot, for example. So that's where this term comes from. I didn't know that story. Jim taught it to me, but it's very interesting. So in our scenario here, what happens if Doug, instead of buying a $700,000 property, what if he buys or I guess you can see down here. What if he buys a $700 fourplex? He borrows $400,000, but he cashes out $100,000. He just takes his $100,000. He wants to go do what he wants with it. Well, then he can pay tax on it, or he has to pay tax on it. If you don't apply that money towards the replacement property, you are going to pay tax. That's it. You're going to pay tax just on what you cashed out. So some people, they strategically take a little bit of cash because, they can stomach paying tax on $100,000 as opposed to $400,000. But that would be called boot. All right. So continuing through, we just talked about a forward 1031 exchange. That's a traditional 1031 exchange. But we're going to mention a reverse 1031 just because they're so common and they're kind of a hot topic. So this would be like Doug, he sees that fourplex and he hasn't even sold the duplex yet. He just knows he wants that fourplex. So he would have an LLC purchase the fourplex. Then later he would sell the duplex. Now he can't own the exchanger. That's going to be Doug. He can't own both properties at the same time. That's why he has to use the LLC. So in case you hear that term reverse 1031 exchange, that's when you identify or really buy the replacement property before you sell the relinquished property. So like I said, in a perfect world, you just do 1031s your entire life and you acquire your properties. Maybe you sometimes exchange one property for two or two for one. You can do that, but you do that your entire life. Okay. So I have a question coming in. First question of the day. So does Doug keep the same low property tax basis of $200,000 after he bought the $700,000? No, he does not. That's a great question. A lot of people have been asking me that lately. So he's deferring his capital gains, but he is not going to avoid the reassessment. He takes that in. Now, one of the things we'll talk about as we go through this today is even though he gets reassessed, he will be able to deduct his new property tax against his income from the property. And so that might be something that once again mitigates the damage, but no, he will get assessed on that new property. So if you can stomach paying higher property taxes, then he does these exchanges his whole life, or you do, or Doug does, whatever it is. And he just holds these properties until he dies. And let's say he has 5 properties, each worth $1 million, and they all have a basis of 100,000. Okay. Well, when he dies and it goes to his spouse or his kids, they get a step up in basis. And I should clarify when I say spouse, it has to be properties in a community property state like California or many of the other West Coast states. That's not available out of community property states. But in community property states, if it's held in trust or in community property, when first spouse dies, surviving spouse gets a step up. So what that means is the IRS treats the heir like they purchased the property for capital gains purposes for fair market value at date of death. So that is very good. I mean, if somebody is going to look at the Internal Revenue Code, the American Tax Code, from outside eyes, like with a veil over it, I think that would be like the biggest, I don't know if you want to call it a loophole, it's very intentional, but that would be the most shocking part of the tax code, is that somebody gets a step up when the original purchaser dies. And so what that it does is it allows his kids to sell and have no capital gains. It allows his kids to depreciate from the new basis and to write off every year a ton of income because the basis is just so high compared to it once was. All right, so we got more questions coming in. Let me check the questions here. If Doug had mortgages in the old property, is it more difficult to get the new loans from lenders in 1031 exchange? That's another great question. I mean, it's all going to be dependent on your credit, but your lender is going to realize that as soon as you get the funds to pay off the mortgage on the old property, they're going to be more likely to lend to you because you're just going to get rid of that mortgage. You're selling that property. You can use the proceeds from the sale of the relinquished property, the one you're selling, to pay off the mortgage. And when we talk about investing in the new property, you use that money to pay off the mortgage. You don't have to invest any money, or like let's say you had $100,000 mortgage against the $200,000 or the $400,000 property. You can pay off the $100,000 mortgage, then you only have to reinvest $300,000. They're not going to count it as boot just because you paid off the mortgage. That's what I'm trying to say. So mortgages, they don't really hinder a 1031. A lot of the people, to be honest, who do the most 1031s have mortgages. I think it takes a similar type of mindset to do a 1031, take a little bit of risk. So yeah, that won't block you at all, unless of course you have the credit issues. Okay, so that's a good question. Let's do one more before I continue. This is from Nicole. If you want to leave California, what's the strategy for selling personal residence, renting it for a couple of years in order to become an investment property and avoid or defer capital gains? So Nicole, that's a great question. I'm going to address that later in the webinar after I talk a little bit about Proposition 19, but I have slides for that too. Right now, I'm just trying to get people really familiar with the baseline of 1031. So the end game with the 1031 is to hold the property until you die, okay? So when you die, your heirs get that step up. So now they take all your five $1 million properties and they can just liquidate them. They can go their own ways. They can keep some, they can sell some, but they'll eliminate their capital gains. So that's the way to look at it. 1031s really make sense if you plan to hold for the rest of your life. Okay. So like we say at the bottom of this, none of this is automatic. You have to make sure that you really coordinate. You know, I've been doing a lot of these meetings in response to Proposition 19. I'm going into story mode now, I guess. And it's really interesting because I'm meeting with people who have kind of neglected going to accountants or attorneys for a long time. You know, people don't like to pay fees, which I totally understand. But like they had a parent die or a grandparent die like 2 or 3 years ago, and they didn't take the step up. So they could have been depreciating from a new basis. You know, they bought the property in the 80s for 100K and now it's depreciated down to zero. They could have been deducting from $1 million in LA, but they just haven't done so. So what I'm trying to do is I'm trying to plead with people that you don't know exactly what you're missing out on, but that depreciation can really, really benefit you if you have a high basis. All right, so I'm going to shift gears now. Well, I guess we'll do one more example. So Doug buys an investment property for $100,000, and this is my example. This is where I kind of take over the slideshow. Doug buys the investment property for $100,000. 10 years later, Doug does a 1031 exchange. Okay, he acquires a new property worth $500,000. We're just going to ignore depreciation. That makes this a lot easier. So the basis in that new property is still $100,000. Okay, he sold his $100,000 property, bought it, he 1031 into a $500,000 property. His basis is still $100,000. So if Doug sold this property himself, he will have a ton of capital gains. He'll have $400,000 in gain. But Doug is not dumb. He's planned. He's going to hold this property till the day he dies, because once he dies, his wife or his child's basis will be stepped up. It will be stepped up to $500,000, and that will allow the wife to depreciate from $500,000. If the wife is really squared away, she'll try to take accelerated depreciation. So hopefully in her last years, the years where she's a widow, she can depreciate she can have no income tax essentially from the rental because she'll be depreciating so quickly. She can depreciate quickly because she doesn't expect to live too long. And when the property goes to her kids, they will be stepped up again. And then the kids can decide, do they want to move? Do they want to sell? Or do they want to keep it and depreciate from the new basis? So this example right here, I know these slides are kind of complex. This is my sum it all up in 5, bullet points. This is a 1031. This is the strategy. You buy the property, you do an exchange, you hold it till death. And that way you'll be putting your heirs in an excellent position. All right, I got questions flooding in. So this is a good question. So if Biden gets rid of step up, this will affect 1031, right? So that's a great question. When Joe Biden ran for president, he talked about changing the step up rules. So like I said, if someone could look at America's tax code from an outside perspective, they'd say, wow, this step up is a really great deal. I guess I'm going to give you guys a history lesson. Why the heck do we have step ups in America? Well, there's an estate tax, a death tax. The death tax is on people who are worth 23 million. It used to be on people who are worth like 60,000 or 600,000. So it affected a ton of people in the 20th century. And these heirs were getting sick of paying death tax and then selling their parents' house and paying capital gains. So in the late 1900s, I don't even know if it was late, but like 1970s, 1980s, IRS comes out and says, look, we're just going to give this step up so you can just focus on the estate tax. We're not going to give you double taxation. And then the estate tax got really high. And so now people are like, why do we even have a step up in the first place? So now there are people who are running for office who say, let's get rid of the step up. Really, they're not quite saying let's get rid of the step up. They're saying, let's just not give an entire step up. Now, remember, it's easy for people to run for president or for whatever position and to make promises. It's a little bit harder for them actually to make the change. And it does happen. We see it pretty frequently. But just because somebody says they want to change things doesn't mean it will happen. But yes, it is foreseeable that the step up is eliminated or taken away, or at least taken back. Like maybe they'll say, oh, you can step up the first 100,000 in gain or the first 250,000 in gain. But yes, if that were to happen, it would make the 1031 less attractive. For sure, it makes the 1031 less attractive, but you have to be willing to bet they're actually going to change the rules. All right, that's a great question. All right, Patty, hello, Patty. She says, does it become a logistical nightmare if you try to sell more than one rental property at the same time, and then use proceeds from both properties to do a 1031 into one property? For example, sell rental home 1 and 2 for a total of 800, then buy 3 for 850. Would that work? And would it be difficult to follow the IRS timelines for 1031? Well, Patty, if I understand what you're trying to say, I would just say you sell property 1 for, the 400,000 I'm going to assume. We'll assume it's half and half. And then you reinvest in an 850. That would probably be the more common strategy. It's more common to sell an $800,000 property and then buy 2 properties worth 450 each. That's when I say 2 for 1. That's what I'm thinking of, more so than selling 1 for 2. I'm not totally sure you can sell 1 for 2, but yeah, I can see where you're coming from. That would be very challenging if you're selling 2 properties for a grand total of 800 just to buy an 850. You could just buy or sell 1 and get into 1 for 850. But I'd have to actually look at the tax code to tell you. All right, so then we get, what's your opinion about whether Congress will get rid of the step up at some point in order to raise tax revenue? We've borrowed trillions in the last year, has to be repaid somehow. And so we have seen a lot of clients raise this concern. And it doesn't quite matter what I think. It matters what we all think. It matters what you think when you want to make this change. This is my opinion. Technically, or whatever it is, there's a Georgia election on January 5th. The Democrats have to win both those seats in order to have a 50-50 split in the Senate, okay? And if they're able to do that, then I think it's more likely that we see changes to the code. If they don't win both those seats, it's unlikely that we're going to see that for at least a couple of years, right? So that's my opinion, and that's totally apolitical. It's just if they win 2 seats, then yeah, I think we need to be on the lookout for these changes. If they win 1 seat or 0 seats in Georgia, then I'm going to rest a little bit easier. But yeah, these tax laws change all the time. And it's really interesting to me because going into this election, people were so focused on Proposition 15, including myself. The one that was the one where we just reassess anything that wasn't residential. And then 19 passed. Like we just weren't quite paying attention because we thought that 15 was going to pass and 19 wasn't. So like it's hard. We know changes come, but it's hard to like foresee the specific change. And so just because changes come doesn't mean that you don't do anything at all. That's how I think a lot of us look at things. And some of you guys probably remember the Secure Act that passed in 2019, about a year ago, December 2019. It's all about retirement accounts. We have plenty of webinars if you want to see those. But it's so funny because, you know, you hear people all the time that say, we need to raise taxes in the US for whatever reason, because, you know, we need to punish the rich or we need to redistribute or we just need to raise revenue, like how Nicole's saying. But like we had a really dramatic tax law go into effect last December via the Secure Act, something that destroyed people's estate planning, people who have been planning for 20, 30 years. And like the news didn't really care. And like people didn't really care that much. Like, I mean, I know there are people who care about the Secure Act, but like it just seemed like there wasn't a lot of hype around it. So my point is these things do change all the time. And that's why it's important to kind of stay in the loop, you know? You don't have to like do your estate planning every day, but you got to really focus. Otherwise you might fall behind. I've had people die before with tax sensitive trusts from 1990 and their life's a mess right now because they can't go to court because the kids don't like the parents. So everything's just a pain. So my point is, if you're going to play these tax sensitive games, you have to stay alert. All right. So a couple more questions, then I'm going to continue. If the kids that take depreciation for several years, do they lose the depreciation they didn't take? So if the kids didn't take depreciation for several years, do they lose the depreciation they didn't take? The answer is yes. And that's just not kids. That's you too. It is use it or lose it. That's the phrase for depreciation. You have no choice. You will have to recapture even if you don't depreciate. I probably should have mentioned that earlier. All right. Anonymous asks, you can eliminate capital gains when the property passes to heirs. Does California conform or will they own California income tax? So another great question. California does conform, but who knows what they do in the future. Now, if the estate tax exemption is lower, then this is going to go back to Nicole's question. Like I said, the reason why there's a step up in the first place was because people were getting hit twice by estate tax and by capital gains. If they lower the estate tax, I think it's a lot less likely that they try to change the capital gains tax because it's very unpopular to hit people twice. And if they're able to come in and say, hey, we're going to lower the estate tax exemption to 5 mil versus the 10 mil it's at now, or even 3.5 mil, like a lot of the progressives want, I don't think they're going to come for the step up as well. All right, so these are good questions. Hopefully you guys are, you know, being educated or entertained at least. Jean asks, explain how depreciation can accelerating according to life expectancy. Well, so like I said, a residential property, 27.5 years. A commercial property is 37 years. That's the life expectancy. It's not the life expectancy of the human. It's based off the thing that's being depreciated. These are all depreciation tables set up by the IRS. I don't know how objectively they're set up, but they're there nonetheless. You can ask to depreciate quicker than what they say. That's their straight line. That's their regular method. You can ask to take what's called accelerated depreciation. So talk to your accountant for more details, but let's say, for example, you don't want to depreciate over 27.5 years, you could depreciate like maybe over 10 years. And so instead of taking that 1 divided by 27.5, you're taking 1 divided by 10. My numbers, I believe they're all correct, the 27.5 and 37, but just make sure to talk to your accountant. That's who's going to be doing your depreciation, not your attorney. All I can do is advise. And like I said, commercial's longer than residential. I believe residential is 27.5 and commercial is 37. All right, my wife passed in 2013. Should I have taken a step up in basis on my rental property? Can it still be taken now? Well, Michael, you are just like a lot of the clients who I've been meeting with. That is a great question. Yes, you probably should have got some step up in 2013, provided your wife was on your deed. If it was in your trust, you should have got a total step up if the property is in a community property estate. If it's a joint tenancy, you don't get a total step up. That's a reason to not own things in joint tenancy, to own them as community property or in your trust. Can you go back and change it? You can amend your tax return for the last, I think it's 3 years. Once again, I'm not an accountant, so those little deadlines I don't have down. But you can definitely go back and amend, just not all the way back to 2013. Talk to your accountant. This is the third or fourth time I've had this conversation in the past month. All right. So if you haven't taken your step up, go get your step up. All right. One last question. Then I am actually going to go on. In 706 portability election of a spouse from the dead spouse, is the house appraised value higher is better or lower is better in view of clawback, though the chance is small? This is for primary residential. So because, okay, this is more of a take an appointment question. This is why it's not legal advice. I don't have time to apply it, the law to your situation. Take an appointment. Maybe at the end of this, you can ask the question again and I'll come back, but that's why we do appointments, because you're asking to apply the law to your situation. And I don't mean to be rude, but we got people on here. They want to see what's going on. All right, so now let's shift gears to Proposition 19. So that was a good breaking point, 1031. So what the heck happened with Proposition 19? So pretty much Proposition 58, that was the old parent-to-child exclusion, that was repealed and replaced. That's the way to look at it. Repealed and replaced. So under the old rule, you could just pass your property tax to your kids on the house you lived in. If you bought a house for $1 million, now it was worth 10 million, your kids would pay the same property tax. It didn't matter how much it was worth. On additional properties, you had 1 million of assessed value you could pass to your kids. Well, this year, the voters, 51 to 49, decided to change the rules. So now, for your principal residence, you can leave it to your child, and if they live in it, okay, if they live in it, and we're going to talk about this, they will not be reassessed. And that's going to be up to $1 million past your assessed value. So let's say your assessed value is $200,000. You can look at your property tax bill. It will tell you assessed value, or it might not use the word assessed depending on your county, but that's what it is, assessed value. If your assessed value is $200,000, your kids will not get reassessed up to 1.2 million. If your house is worth 1.2 million, they will get reassessed even if they live in it. And people have been asking me over and over and over, if I have 2 kids and I leave my house to my kids, do they both have to live in it? Yes. If they both want to own the property, they both have to live in the property. It's an incredible law, right? Proposition 19, very, very practical. So essentially, they have to move in within 1 year. And if they both want to own it, they both have to live there together. I don't know exactly how long. No one knows. It might be indefinitely. It might be for 2 years. We're just going off the text of the law that's been released. Like the proposed law, we don't have anything like regulations, anything like that. All right. So continuing through, additional properties you own, they'll just get reassessed. So if you own a rental property, if you own a vacation home, whatever it is you own, it will get reassessed. And that's a bummer, right? Because it just doesn't seem that fair. There are a lot of people who have excellent tax breaks in some places, and this doesn't really get you. Anyway, it can really hurt people. So right now, a lot of real estate investors are kind of in a panic because they always planned to pass their property tax to their kids. I meet with these people who bought a property for 200 grand back in the 90s, and now it's worth $1 million. They're paying $4,000 a year now. And if it goes to their kid, who oftentimes makes less money than they do, their kid's going to pay like 12, 13 grand. So they're like, my kid's going to have to sell. So people are panicked. And in panic, let me, before I start talking about strategies, I want everybody here to take a deep breath. In panic, people sometimes think emotionally, and you still have to approach this logically to make sure that you get out of it safely. Because if anything's going to be done to preserve any Prop 13, it has to be done by February 16th. So the clock is ticking, and you really have to focus on getting things done quickly. So really, if you're trying to determine whether to make a gift or anything like that, that's what we're really going to cover. But it doesn't, just because you have low property tax, what I'm trying to say, just because you have low property tax doesn't mean you necessarily should gift to your kids. So let's go to the next slide. And I have a couple of Q&As building up. Let me go through a couple of slides and then I'll hit more Q&A. So like I said, as a response to Proposition 19, we see a lot of people gifting to their children, almost always utilizing a trust in some sense or another. A lot of people know, a house is still $1 million. They don't want to throw it into their 36-year-old child's name or even their 50-year-old child's name because they don't want their child to get into some trouble and then lose the house. They'd rather put some type of barrier there. And that's really the purpose of a trust for a lot of people. And oftentimes they want to control the property and they want to act as their own trustee. But even so, I've seen some people say, you know what, I'm just going to give the property to my kid before February 16. I'm going to claim the Prop 58 and they are going to keep the same property tax indefinitely. But there's a catch here, okay? And that's what's called exchange basis or carryover basis. We've talked about step up in basis this whole time. You die, your kids inherit. They take the basis based off of fair market value. Now, before February 16th, if you just gift it to your child, they will take an exchange basis. And that means it's going to be your basis. So that first sentence, if you gift your property to an heir, they take your basis. So example, Doug has that property worth $500,000, but in this hypothetical here, he purchased it for $100,000. And he gifts to his son before February 16th. So son keeps the same property tax as Doug, but son's basis is $100,000, okay? Still $100,000. So if the son wants to sell, his gain is going to be based on what was past $100,000. And the son, he will only be able to depreciate from the $100,000 or whatever is left, whatever his father hasn't depreciated. So you're exchanging a good property tax for bad capital gains or for bad depreciation. So that's why it doesn't totally make sense. In our little one-on-one meetings, when I meet with my people at least, I try to go through and calculate the depreciation. Because let's pretend that Doug is my client and he's coming to me and saying, should I transfer to my son now? Should I gift to my son now? And there's going to be several factors involved. But for this particular situation, okay, if his son were to get a step up, his son, he'd get reassessed. He pays $7,000 a year, but he'd be able to depreciate from this new $500,000 number or whatever the building is. So, let's assume the building, I'm going to pull up my phone like it's a calculator. Let's say the building is worth $400,000. We divide that over the 27 and a half years, and that's $14,500 a year that he can write off the rents from the house if he's renting it out. And then remember that $7,000 a year in property tax, he can deduct that too from the rents. So even though he's paying more in property tax, the son, he's still going to be able to write off a lot of the rents. If he has his father's basis and he has his father's property tax, he won't be able to write off. So it just kind of depends. Do you want your kids to have the low property tax or do you want them to have the low basis? And I can hear someone like Nicole on this webinar being like, well, look, I'm tired of getting screwed by the government. They keep changing the rules. They keep changing the ball. I'm just going to lock this in. I'm just going to give my son the property now because I don't even know if they're going to give my son a step up when I pass away. I've met with people like that over the last month. So it like these decisions on how the world's going to go, they come down to the client. I can just advise, we can recommend things. But what I'm saying is it's not just as simple as if I give to my son now, he's going to have my same property tax and that's it. It's going to be a win. All right. So I told people, 11 or 10:45, hopefully it's going to go over that for sure. But if you have to hop off, you can hop off. All right. I think it's a pretty good conversation. So we're going to combine these. So let's say we go back to the same situation where Doug gives to his son and his son has that basis of 100,000. Now his son's one escape is he still has the ability to do a 1031 exchange. Okay. So son is gifted property from his father. He was given the property and he has that $100,000 basis. Okay. He's paying the low property tax. Well, he's just sick of that property. He's tired of he's okay with the low property tax, but he wants a new property. He wants a more expensive property. He doesn't want to pay any tax. He can sell that property, do a 1031, buy a replacement property. He won't pay any of his father's gain. He'll get new depreciation on this new property, but of course he will defer or he will keep the low basis. So he defers the gain. So it's combining Prop 19 with 1031. So it almost turns like, it's almost like the parents using Prop 19 as a deferral method to buy the kid more time. So the kid has the ability to get out and do a 1031, or the kid has the ability to keep the property and keep the same property tax. So that's one of the reasons why, or that's one of the things people should consider. If they know their kids might want to keep the property, they might want to keep the property tax, they still will have that escape clause through the 1031, unless, of course, the laws change. But it's hard to anticipate if the laws are going to change. All right, let's see what the Q&As are before I continue. Can you sell an income property in California and buy something in another state or put it into a REIT? What are the tax consequences? That's a great question, Lisa. I'm actually going to do a slide on that. It's not quite a REIT, but it's really close. I will talk about it. If you do a 1031 and you reinvest in an out-of-state property, you guessed it, California, they're going to want their cash. So you'll defer your federal, but you won't defer California. California wants their cash because California is California. All right, my father passed in February this year. If my mom redeeds a rental property to me, can I preserve low property tax basis 100%? Do I get a step up in basis for my father's passing? Alice, you are the ideal client. I have a slide just for you. Now, I can't guarantee she can pass you the low property tax. I'd have to look at her situation, but that's the people who are most excited, or the people who are acting quickest, the people who recently got a step up and who have low property tax. Those are the people that should probably consider acting right now. All right, Anonymous says, would the gift has a basis based on the value at the gifting time, not the original purchase price? No, the basis is the original purchase price, not the value of the gift at the time. It's the original purchase price, of course, minus your depreciation. But good question. All right, Anna Miller, what if kids buy property from parent instead of gift from parent? Is that better for basis depreciation and Prop 19 and 31 exchange later? Well, yeah, if your kids buy the property from you, then that's great because they are going to take a step up, but you might have to pay capital gains. That's why it's not so easy. You'll be paying tax now so that they can defer later. But that's a good question. You're on the right path. All right, so let's continue through. The best candidates. So just like that last question said, who are the best people? And it's going to be right here. People who recently got a step up, okay? So that means that one spouse died recently, just like in that hypothetical. I have a lot of people like this. Their parent died within the last year, maybe the last 5 years. And now their other parent is old. They're 90 or 95. And, you know, I mean, I hate to be negative Nancy, but the 95-year-olds, they don't live that much longer. I hopefully that's not too controversial. But I mean, people just have to do the math here. There will still be basis left to depreciate when the parent passes away. They will sacrifice the second step up in order to pay the same property tax. So if that is you, I highly encourage you to take a meeting. And of course, you know, today's December 17th. We have the holidays coming up next week. You know, if this is something you're looking to do it quick, because we got to get deeds signed before February. You know, deadlines, you know, I try to prepare. We got to get these things signed in January. So we're running out of time. All right. So it's not just though for the people who had the one spouse die recently or the parent die recently, whatever it is. You know, I had someone too who just inherited from her parent and her son wants to live in the property. He wants to live there. So it makes sense for her to just give the property to him, most likely. I mean, who knows how long she's going to live. Maybe he have an incredible step up one day, but he wants to live there. He doesn't want to pay $12,000 or $15,000 a year in property tax. He'd rather pay the two. She inherited her mother's property tax, and that's why it's so low. All right, so then another great scenario where this makes sense is for vacation homes, where the children hope to never sell. So, you know, if you bought that property on the ocean for $200K and your family loves it, you're not depreciating it because your family goes there, right? And if you think you're going to keep it in the family forever, then it really does make sense for you to gift, because then you'll keep the same property tax. And if you never sell, you'll never have any capital gains. And if you don't rent it out, you'll never depreciate. So that's the second example. The third example I didn't write down here, but I am going to talk about it. I think the group here seems sophisticated based on the questions. So a lot of people are gifting right now. You heard one of my questions, I think. She talked about the clawback. I don't know if I read that out loud, but the clawback. So right now, the exemption is 11.58 million. That's for estate tax, death tax. So if you die, and as long as you have 11.58 million or less in assets, they won't tax you. You can give it away to your kids tax-free. And for married couples, it's 23. It goes up to 11.7 in January. It goes up for inflation every year. But on December 31st, 2025, so January 1st, 2026, it gets cut in half. That's what the current tax laws say. And it doesn't look like they're going to get extended because Joe Biden's president, right? They're not going to want to extend that one. So I have a lot of clients who think that they're going to cut the estate tax down to half of what it is now. So what they're doing is they're gifting away 11 million or 9 million. And the reason why is because if they do lower the estate tax, the IRS has said that if they gifted away more, I'm talking about if the person's gifted away more than whatever the estate tax is when they die, even if the estate tax is lowered, they're not going to claw back. Okay. So like, for example, I have somebody give away 9 million. Let's say the estate tax exemption is 3.5 when they die. They're not going to come back for that other 5.5. They're going to say, okay, you got away with one. So now I have people who are considering doing this. They were going to wait until like 2025 or maybe 2022. But now that they can give away property and pass on the low property tax, now they just want to do it. They want to make that gift. They want to file the gift tax return. They want to lock in their exemption, and then their kids get low property tax. So if that's you, that might make sense. All right. So now I got a ton of questions. So I'm going to try to get through them quick. If your 1031 fails for lack of identifying a replacement property within 45 days, is there a way to defer paying tax? That's a question. I have to see a particular situation. Maybe that's a question for a particular situation. All right. So Anna asks, so if I buy mom's primary residence condo from her and she has the 250 exclusion from gain now, then is that the best strategy for depreciation, Prop 19 and 1031? Yes, that sounds very good. If you can afford to buy your mom's condo from her and she has that 250 exclusion, perfect. That is an excellent strategy, Anna. For Prop 19 planning, what kind of trust are you talking about? Can it be a regular trust where you maintain control, or does it have to be a grid? I think grid, you mean GRAT? I could be wrong, but there are various Prop 13 trusts. The one that I've been talking about right now is a non-grantor gifting trust, okay? So it's as simple as client gifts to trust, child is beneficiary of trust. That's why there's a change in ownership. Client can act as trustee to maintain control. That's about it. There's a gift tax return filed, no step up upon death. There are various Prop 13 trusts that we're doing depending on the client's needs, but that's the most common one. All right. Anonymous says, property is in revocable trust. Parent passed away in 2013 and property was supposed to go to daughter. No transfer ever happened. Property is worth 1.5 mil. Property tax is 100,000. Should they just leave the property in trust or transfer prior to February 15th? Will it get reassessed since it is more than 3 years? Once again, this is more for a specific. So, I mean, I think it's worth $500 to make an appointment. You know, I'm not trying to be rude, but like it's such a specific one. You probably need some legal advice on that situation. All right. So next question. So Anna didn't tax on. And can I give my mom contractual right to occupy for life? Not life estate, or does she have to rent from me? Well, definitely not life estate. I'm on YouTube here, or I'm being broadcast. So I don't really want to be recorded giving my answer. So this is another one where you probably want to make an appointment, because this is really trying to tailor the law where you give that right of occupancy. I can give you a hint though. If you're going to give a right of occupancy, it should be limited to a number of years to not do change of ownership back to your mom. Okay. And then finally, we have Anonymous that I'm going to continue through. Is it expensive to have attorney or CPA trustee for a trust about 5 million? Is it worth it due to immature child? Are there less expensive ways? Well, you don't have to have an attorney or a CPA. They're fiduciaries. Like Cunningham Legal, at least at this point in 2020, we don't act as trustee because it's a totally different ballgame to act as trustee. I think there are some really great trustees that are reasonable price, you know, that's our good word. If you call in and ask, I can refer you to some people, depending on where you live, of course. But I don't think they charge that much. And I mean, remember, I don't know how many kids you have, but the kids will charge too, more likely than not. All right, let's continue through. So you guys can see where it really makes sense to do this Prop 19 planning. So I know this is a big question too. Can I avoid reassessment and get a step up? Possibly. That is like cutting edge law, we'll call it. Take an appointment. We'll try to figure it out. But I will say, I don't, yeah, I'll take an appointment, figure it out. It is possible to get both through some really tax sensitive trust. All right, so let's go back to 1031s. Oh, I do have one more question. If I think my estate size will exceed 19 million for both spouses together after 2026, is it better to have my mother put a rental property I anticipate to receive from my mother into an irrevocable trust now? I think it's worth the discussion, right? I think your mom, if she, I mean, it probably wouldn't just be one, it would be a few because she wants to go past her 5.5 or whatever it is that it's going to be when she dies. She wants to lock it all in. So it's worth doing an appointment to figure it out. All right, so let's go back to that question where somebody said, I don't want to manage any more real estate. I want to do a 1031 into a REIT. So there is something you can do. So you can do a 1031. We go back to Doug. He sells this property for 500,000. He bought it for 200,000. But instead of putting it into a new property, he puts it into something like a REIT. It's really called a DST, but it's not publicly traded. So what is that? Well, like a REIT. So I like investing. I buy a REIT called Realty Income. If you guys invest, you probably heard of it. It's on the stock exchange. It's just ticker O. And what that is it's a bunch of companies like these here, companies all across America and the UK. And every single month it pays out a dividend. Okay, every single month. A lot of companies, they pay out dividends, twice a year, 4 times a year. This company pays out every single month. That's what makes it unique. This is a REIT. So it owns Starbucks buildings, it owns Walgreens, CVS buildings, and it pays out a dividend. So I think right now, Realty Income is trading at $60 a share, and it pays like 24 cents a month. It's probably like 4 or 5% dividend every single year, annualized. So you can't exchange into something like Realty Income, but you can get into something that's for accredited investors. How do you qualify to be an accredited investor? You have to have $1 million in assets, besides your home, I believe. $1 million in assets, and you can invest in one of these things. So you can sell the home and get into one of these DSTs. And like you see here, you're probably going to have $45,000 in income per 1 million. So the pros are, it's a passive investment. You don't have to do anything, right? You don't have to manage people. You just sit there and collect your income, and you still get depreciation. Unlike a REIT, you get depreciation on these, but the cons are it's not marketable. You can only sell to other accredited investors, and then you have to wait for 7 years if you enter into one of these. If you have questions about it, I mean, it's a really popular strategy. If you have questions about it, you can ask us. I mean, we do estate planning, but we can definitely refer you to somebody who can help. We can help you structure the sale. But this one here, this is a good way to get out of being a property owner. Someone says, what does DST stand for? Delaware Statutory Trust. Delaware Statutory Trust. If you have questions, you can ask. All right, so 1031s and vacation homes. We had somebody ask about this. So you can't do a 1031 on a vacation home because it's not a business property. But you can exchange a vacation home if it's regularly rented out as a short-term rental, okay? So you can still occupy it for 14 days a year, but it can't be more than 10% of your time. So if you occupy it for 14 days a year, and that's the max, you have to rent it out for 140 days a year, and then you can do a 1031. So if you're interested in doing a 1031 on your rental, you got to, or on your vacation home, you got to rent it out at least some of the time. And then I put the tagline here, you must do this for 2 years. That's disputed, but I think to be safe, it's 2 years. All right, and then finally, section 121, primary residence. We had someone ask about the 250 exclusion. It's 500 if you're married. As long as you've occupied a home for 2 of the last 5 years, you get this exclusion. You can only claim it every, I believe it's 3 years. I could be wrong, but you get this exclusion. So if you sell a home that you purchased for $100,000 or $200,000 and you're single, you have $250,000 you're allowed to exclude from the sale. And if you're married, that's $500,000. So some people really, here we go through an example. You have Doug, he bought the house for $750. Now it's worth $2.575. So if Doug sells the home and moves to Las Vegas, he has a $2 million in gain. That's a huge amount of tax. But first, Doug can move to Vegas and then he can rent out the home. And once it's deemed a rental, so once again, after 2 years, he can then do a 1031 into a new rental in Las Vegas. And after a couple of years, he can even move into that rental and he would defer his gain. So it's a 4 or 5 year transaction, but it still works. Now you see our warning here, step transaction, that's absolutely correct. You run the risk of having the IRS say it was all one move. So just be careful for that. All right. So finally, this is it. This is the last thing. I know it's getting to be a long webinar, but we talked about quite a bit, combining 121 and 1031. All right. So Doug buys a home. He lives in it for 2 years. Then he rents it out for 3 years. In year 5, he still gets that $250,000, $500,000 exemption. He can sell the property to himself to establish a new basis. That is a strategy a lot of our clients use. That's kind of a bonus strategy. He can do it in reverse as well. He lives in the rental for 2 years to claim the 121. So after that, he can do a 1031. Doug can rent it out for 3 years and he can live in it and get the 250, 500, 121 exemption. Because right now, I got 2 of them coming in. Anonymous. Is it not a good idea to serve as trustee for GST to avoid the tax issue or other issue to be viewed as your trust? Yeah, if you're doing a GST, if you're allocating GST, separate analysis. So that's another reason to do an appointment to talk about that. Are you saying that if you trade for a vacation home, you only have to rent it for 2 years and then you can live in it? Well, I'm not saying that, but do an appointment to find out what the tradition is. But I mean, typically a lot of these tests are 2 years. So do an appointment and we can talk about it. It's not quite 2 years because you got to do it on the back end too. It's going to be longer. But take an appointment and we can specifically talk. All right. So that is essentially it. If you don't have any more questions, we'll call it a day. This video will be made available on YouTube if you want to watch it again. Otherwise, please make an appointment. Like I said, right now we're doing appointments, 1 hour, $500. I mean, whether you want to do a review of your current estate plan, whether you want to talk about 1031s, whether you want to talk about Prop 19, or whether you want to set up an estate plan for the first time at all. Just call in, make an appointment. That is it. Okay. Well, I appreciate everybody coming today. Hopefully you guys all have a nice holiday, whatever it is that you celebrate. Happy New Year, and we'll see you next time.